The following program on Biz is rated R. It contains valuable financial information and is intended only for mature audiences. Viewer discretion is advised.
Think of us like Ethereum or Bitcoin in the sense that that network of now 20 chains appears as a single network to you.
Wow.
As a user, it's not something you should really have to think about. The main thing users can think about is that not only do we have dirt cheap, practically free gas costs, not only do we have gas stations, which make it possible for an app developer to, subsidize your gas costs, so you don't even have to think about gas. It also means that once a dApp gets hammered, we're launching a DEX this month called Kadena swap, and one day that's going to get pretty busy. What you see on Ethereum is as things get busy, gas prices go up. That's where the scalability is so important, because one of our chains is the equivalent of Ethereum today. So we already have 20 times that throughput, and we can scale out as needed. dApps can actually independently scale out as needed to take advantage of as many chains as they need. And the idea is that if we ever get to a place where gas prices are spiking again, add more chains.
And so they did an agent-based simulation of Chainweb, and they proved what we asserted, which is that Chainweb security stays stable for the same amount of hash rate, no matter how many chains you have. And that's an incredibly unique property. It means that Chainweb can scale infinitely, which is a crazy statement to make. And of course it's not infinite, because eventually you're just sending too much data. But the point being is we can scale to any conceivable load using the same hash rate. And the weirdest thing is that the network gets more secure the more chains it has. It gets harder to attack. And this is what they validated in their security report. So this is a very unique property. The best fast finality proof of stake system. Oh, we just saw something about this, right? The Binance chain. There's this thing where, Pancake was saying you need to put in more gas.
Right.
So even fast finality proof of stake systems will hit their limit. And when they hit their limit, there's going to be nowhere to go. And Chainweb will never, now to be clear, it's a hard fork to go to more chains. So it doesn't do it. There's no magic there. It's like it's a fixed graph. The main innovation of Chainweb is the graph layout, because it means that otherwise the bigger the network got, the slower it would go, because you'd have to be talking to every single chain to incorporate it. So Will's big innovation was using expander graphs to be able to say, not only do I only need to talk to a subset, and if you look at our block explorer, the image there kind of makes this really clear. You see like 4 lines coming down from one block, and then you see from those 4, they each have 4 lines going down, or whatever it is. Whatever the degree of the graph is. And so on our block explorer, you'll see a new block showing up like kind of 3 block heights above sometimes. It's got enough flexibility to make progress. But the point is that no progress can be made if that hash does not propagate to all the chains. And that has the corresponding, so that's looking back in time. Now looking forward in time, if you want to attack that chain, that means that you have to attack 4 chains on the next block. And then, I'm getting the numbers wrong, but it's like
I think we get
you have to increasingly attack more chains, and you basically have to take over the whole network within like 3 blocks. And everybody knows that you can't have a successful 51% attack with just 1 block. You have to have a number of blocks. So by the time you've gotten to 4 blocks, you've had to take over every chain in the network.
We don't use proof of stake. We use the only consensus mechanism that's actually been proven in the field to be safe and to work reliably. And we just increase its throughput dramatically without having to have it cost any more energy. So instead of the very basic idea of it is that with a Bitcoin or an Ethereum, and anonymous, anyone can come in and mine the next block in the chain. And when you mine that block, it points at the previous block in the chain. With Chainweb, think of a 2-chain version of Chainweb. So when you mine the next block in either chain 1 or chain 2, it points at the previous block in chain 1 and also the previous block in chain 2. And as you do this, you end up doubling the throughput, you don't need any more energy because you're actually chopping the difficulty per block in half in this case. And you're actually increasing the security. This idea of having two chains braided together is an older idea than Kadena. It's called beta coin or block rope. And you can find it on the Bitcoin forums. And it was proposed first for security, not for throughput. Kadena's main contribution is figuring out how to take that seed of an idea and actually scale it dramatically. So we added graph theory to be able to go, instead of having 2 or 10 chains in parallel, to having hundreds, if not thousands of chains long term.
Do you think that in order for something like, what you're trying to do at Kadena, is it possible to do it closed source, or is it necessary to have it open source, kind of open it up to the world? A mass adoption is really my, kind of my point here.
Mm-hmm. It's a solid question. I don't think that anything that is going to be used by general, normal people, we're not talking about, large institutions, can ever be successful and be closed source. An example of this, I think, is Hashgraph's consensus protocol. Their actual node software is patented and closed source, and I think it's going to stand in the way of adoption in a pretty dramatic way.
Interestingly enough, from the proof of work point of view, is that adding chains does not require more hash power, and in fact is more efficient, and you get more security for your hash power dollar. Because a concern, and an understandable concern about proof of work, is the energy consumption.
Right.
But the argument we like to make is that the problem with something like Bitcoin is not that it consumes energy, is that it does so inefficiently and wastefully. We've been putting more energy into Bitcoin in the last 10 years for security that it just doesn't need. And ever since then, it's just been more and more and more and more energy to get the exact same result. Well, with Chainweb, it keeps horizontally scaling for the same energy consumption. So, the idea being that proof of work is still the most secure and decentralized algorithm out there. And nobody really disputes that.
What are your thoughts on the environmental implications of proof of work energy consumption?
One thing I'd add to the discussion of how the electricity grid works is that a lot of people aren't aware of this, that we don't really have the ability to store electricity in large quantities right now. Probably the best example of to what ends you have to go to is there's a man-made lake out in Britain that when the grid has excess energy, the turbines that are below the lake, because the lake's up in a mountain, the turbines pump water into this lake. And then when the grid needs more energy, they switch the direction and the turbines generate electricity to put back into the grid. It's incredibly inefficient, but it does exist. This is one of the weird things of the electricity grid is that let's say that the numbers are right and that Bitcoin does use some hilariously large amount of electricity, and the numbers are not right. It doesn't matter. And it's more than, the country of Iceland. The dam in, I think it's Sichuan, in China, where a lot of the Bitcoin mining goes on, that dam itself produces more electricity that is wasted, that is just like excess, than the country of Iceland itself uses on an average basis. It's just that we have this tremendous amount of extra electricity because that's how the grid works. So a lot of the times people actually get paid, you can get into these arrangements where the electricity company will pay you to take the electricity because they need to get rid of it somehow. And a lot of miners do actually work off of these spot rates for electricity. The whole, all the stories about how Bitcoin is going to use more electricity than the rest of the world, than the entire world in 2 or 3 years, or how it's all dirty energy from China, from coal plants. In that, all of the citations and all the research come from one blog that is just digeconomist.com. And then even in that blog, when they reference numbers from bitcoinenergyconsumption.com, bitcoinenergyconsumption.com actually redirects back to that blog. And you can actually, there now are some really good debunking articles about this. You can watch how the person who was behind this built this story up and brought it further and got it into the limelight, and then got peer-reviewed papers that were based off this false assumption. So the notion that Bitcoin is affecting global warming in any reasonable way whatsoever is just utterly false. And it's actually a pretty amazing trick of using the modern media system against itself.
Do you guys feel it's a tragedy that proof of work burns so much money a year in scams and thefts? And we'll start with you, Will.
No. So I come from a traditional banking background. I would disagree with the premise of the question. But I think the question is, proof of work is burning billions of dollars in energy a year, even more than all scams and thefts combined. The second part is just wrong. And isn't this a big tragedy? No, it's not. This energy, most of it would go to waste anyway, because this is all excess. And for the parts that aren't, until Bitcoin existed, the way if you wanted to have a global currency that would be accepted everywhere is you needed to have a country and an army. And like the energy requirements of having a country and an army to back the US dollar is tremendous. The idea that you could secure a global ledger of value and all you had to do was pay for the energy required to mine it, that is, to someone who's come from big finance, that's amazing. Like that is such an amazing feature. It's not a bug. We know exactly what the energy requirements are. We know what the security parameters are. This is just a tremendous step forward of, okay, well, I don't need an army anymore to have a notion of value. It's crazy. The second bit is that one of the existing system today, it is not good at using energy where the energy is cheap and renewable. With Bitcoin, you can secure a block where the energy is getting used. You can move the site of energy usage right next to the source of where the excess energy is coming from, right next to where the green energy is coming. And that's also a tremendous step forward in that we can actually decouple the actual transfer of value from the place that it is secured. So to me, no, this is a feature. It's not a bug. It's an amazing feat of engineering that we can even talk about, securing billions, if not trillions of dollars. And all we have to do is pay for some electricity.
So one of the things about the DEX is that, of course, we want trading to essentially be free for users. And the future of that, since we have to solve scaling a DEX, and we're already about multi-protocol, well, our smart contract language already runs on Cosmos, and we've got a proposal getting it onto Polkadot and Kusama. So once we have it working on our network, it's a natural leap to put it on Cosmos and on Polkadot, and you're going to get to this future where you're not even going to think about what platform you're on. And
Right.
Of course, we see some of that today, right? I mean, you see these DEX aggregators, you see these people who are trying to give the users this experience, and that's great. But they're doing it in an off-chain way. And I don't know, the debates about layer 2, it's not even layer 2. These things are just, they're just acting like centralized exchanges. They're giving you market access and in exchange for centralization. And it makes sense. I don't fault that. But we're going to be able to chart a course towards a DEX, a decentralized exchange on a decentralized platform that actually reaches out to all of the other decentralized platforms. And so in other words, you'll be able to enjoy all the security that you have today with a Uniswap and all the transparency. But you won't have to worry about getting into these discussions about oh, but I got to decide which platform I'm trading. I mean, who cares, right? The exciting thing that's happening in crypto today is the explosion of all these different ideas about value and about how these currencies are going to solve different problems. And that's the multi-protocol future that we're tracking. That's what we're really passionate about. Right.
Sure.
And so we're going to wrap Ethereum and bring it onto platform. Also, we're going to wrap our token, KDA, and bring it onto Ethereum and Uniswap. So that's another important development. That's how this is a two-way game. It's not like we're not trying to kill Ethereum. We're called an Ethereum killer, but that's kind of like a category of blockchains with smart contract language that are trying to do something similar to Ethereum. But that's really not what we're doing here. We're extending the Ethereum world. So we're going to be able to also have our token be on Ethereum and be in Uniswap. So that's good for the KDA ecosystem because now there are more things to do with KDA. 2021 is going to be a huge year. This is all we do now is focus on making these things happen that really kind of bring in the community, bring in market makers. The time is now for this ecosystem to grow, for this. It's not just DeFi, it's all the other things that are happening. The pace of innovation is just so fast right now. And, what we're doing is we're showing that the value's there. And then it's going to be something where developers are going to be really psyched once they realize how easy it is to use our platform. But we're making it so that you don't just have to believe us. There'll actually be tokens there and you can work with that and you can make a business happen. So this is the year that, last year we launched this enabling technology. This year we're using it and really exciting things are on the way.
So that's, so the kinds of things we're passionate about are, really bringing the original blockchain vision to what we think is its logical conclusion, which is scalable systems that can grow, smart contracts that are accessible to anybody and understandable by anybody and safe. And now kind of the most exciting thing is that we're starting to see that come to life in the form of the DEX. That DEX, Kadena Swap, is going to be the first true multi-protocol DEX in crypto, in DeFi. It's going to allow trading eventually every valuable asset will be on Kadena Swap. It'll be running on all of the chains that make up Kadena. And because Pact today works on the Cosmos ecosystem, and we're working with Polkadot to bring Pact up the Polkadot ecosystem, Kadena Swap will leverage that so that you'll be able to be on one DEX that can natively access tokens in Cosmos or in Polkadot, Kusama. And there's some interesting things that are going to be happening with liquidity provision in the DEX to make it that those pools are not fragmented. And this is something we'll be drawing directly from experience I have working with the national market system for US equities, where you have NASDAQ, BATS, NYSE, these different exchanges, being able to offer a unified market to the consumer. That's the model we're following for the Kadena Swap DEX. If people aren't familiar, when you work with something like Uniswap, one of the things you have to do is authorize the Uniswap application to trade on your behalf. Now, Uniswap is a reputable company. Their software is all open source. So when you click that authorize button, generally speaking, you can be confident that that software is not going to use that to do a trade you don't want them to do. However, you have basically signed a blank check, something worse than a blank. You've signed a blank check with no limit. Blank checks are pretty bad. It's about as bad as a blank check, and that's because that's the only way people have learned how to do an on behalf of trade with the ERC20 infrastructure. And that's across Ethereum and any other EVM platform like Binance Chain. It all works in this kind of trusted mode where you're just hoping that application, remember, it could be a bug. It doesn't have to be malicious. There could be a bug where it puts an extra zero or puts a decimal in the wrong place. And now you've lost money and you can't get it back because we're on a blockchain, especially dealing with decentralized exchanges, non-custodial exchanges like Uniswap. Once it's in, that's it. So it's a fundamentally different model on Kadena Swap, and with Pact, each trade is authorized as it gets signed so that you can see the actual limit on how much money could leave your KDA account in the signing UI. So
that's huge. I don't think people understand that, and I want to make sure that I highlight that. If that is unbelievably impactful, I don't think a lot of people understand that. I don't think a lot of people understand the inherent risk that they're taking when they do that. So I think more people need to put emphasis on that.
Well, again, it's like a lot of things in Ethereum right now. I mean, there's a lot to be happy about in the Ethereum ecosystem, and we're, of course we compete with Ethereum, but we're huge fans as well. And we're huge fans of what's happened in DeFi. You can't have an anti-Ethereum attitude. It'd be like having an anti-Bitcoin attitude, even though some people do. That's insane. Why are you in crypto? It's understandable that Ethereum is having problems because it was the first iteration of smart contracts.
Sure.
And we're very attentive students of Ethereum's design, of the EVM's design, of what Vitalik and Gavin did exactly in those architectures and what they got right and some of the things they didn't get right. So for instance, the whole thing of on behalf of trading, that's extremely unsafe. And it comes from, one of the things it comes from is just the fact that the entire architecture was designed around a single sig transaction. And, there's lots of really complicated and unsafe workflows that people put up with on the Ethereum platform because it's where everything's happening. So, so it's not to criticize, it's more to say that, this is great and we're here to take it to the next phase. And the next phase is a much safer operating model where it's much, much harder for a malicious piece of software to take your money without you knowing it. One of the things about Kadena is that we have an integrated notion of gas stations so that a DApp author can subsidize and since we have low fees, this doesn't represent.
Which is fantastic. The gas station that is an awesome idea. Could you just go over the gas station model and how that works real quick for our users?
Sure. The gas is a concept that comes out of Ethereum, and it's an important one for a public smart contract blockchain, which is that you need to charge a fee for how much compute and how much space you're using on the blockchain to prevent people from using denial of service attacks there's a lot of griefing that can go on with the blockchain if you don't have a cost model surrounding smart contracts. So, that's a fundamental in an open system. So gas isn't the problem itself. The problem on Ethereum today is one, Ethereum can't scale. So as it gets busier and busier, gas prices
high gas fee.
The sender of the transaction in Ethereum is the person who pays the gas. What Kadena introduced is the ability to intermediate and offer a different account to pay gas, or even a program to pay gas, so that you can even set up a system where you're paying for gas using an entirely different token.
Yeah.
Now, of course, that means that the token issuer or the token controller is paying gas and KDA on your behalf. But because we're scalable, that's never going to break the bank. And most importantly, it means one of the biggest problems with Ethereum without a gas payer solution, because they're difficult to administer. They're very creaky systems, but there now is a way to delegate gas payments in Ethereum. But when you consider those costs, you got to think, what business model are you going to have subsidizing those? Because if you have any success, it's going to hit you really hard, and you're going to have thousands of dollars, tens of thousands of dollars in gas payments. Nonetheless, they have some kind of crazy proxy-based solution that allows something like a gas payer. Whereas in our system, it's a native. You can do everything from just straight subsidy, and we have a lot of those. So for instance, we have a gas station that's just for Kadena swap. We're always looking at industrial scale. So industrial scale is where you have, even if gas transactions are a fraction of a cent, you might have enough of those that you actually need to think about how you're going to manage that kind of in bulk. So these are the kind of things that we designed the system from the forefront, and it's because our background really is in industrial scale systems and trying to figure out how to bring these to the masses, basically. Once you get outside of Ethereum and you start looking at proof of stake systems, you have architectures that these days have a significant amount of assets on those platforms, and it's nowhere near as hard to attack those platforms as it is to attack something like Bitcoin or Ethereum proper. It's going to be much, much harder to attack Chainweb than it is when you have a single participant in like a proof of authority system, or if you just have enough money in a proof of stake system. Because the same thing that Satoshi was talking about, where it makes more sense to play along with the system, isn't always going to apply, but it will apply for a while. And the reason why is because there's so much money still coming into crypto. Bitcoin is still a fraction of the market that it's going to be. And Ethereum is still hitting a fraction of the market that it's going to hit, Ether. And so as long as that is true, there are going to be new participants and new money coming in to crypto, and they're going to be looking to DeFi for returns. And once returns go out of a particular token or a particular platform, they can just switch to another one and continue to make earnings.
Yeah.
Eventually, though, that's going to change. And then those returns are going to come down, at which point it actually starts becoming profitable to attack some of these platforms. And, like all 51% attack kind of motives, you're going to victimize like an exchange or something. You're going to find a vulnerability. And what's going to be scary about some of that stuff is that all you will need is money to do that. You'll just need enough money to buy up enough positions in a proof of stake system, and you will be able to attack that system irrevocably. Proof of stake is a very interactive protocol.
Let's delve into that a little bit. So when you talk about proof of stake being interactive, you're referring to the fact that the staking nodes need to be online in order to validate, right?
Correct.
But in terms of proof of work, if your mining facility is not online, then you also won't have a say at the moment of the transaction, right?
No, but there's here's what I think is interesting about Bitcoin and Ethereum, is that they rolled out on the most resilient distributed application infrastructure ever developed in the history of computing. We could have a global power outage for 2 weeks, and Bitcoin and Ethereum will come back up without a hitch. And the reason why is that, you'll have some forks, there'll be a few moments of confusion, and then everything just comes back together. That's what non-interactivity is all about. Proof of stake, on the other hand, it's not just it's not because people are aware of the problems with Polkadot where people got slashed and things like that, and all the requirements that validators stay online. What they don't realize is that it's not just the validators, it's actually the integrity of the changing validator set stream. This really impacts writing bridges, because a bridge now, you can't go offline as a bridge Because if you miss one of those validator updates, you basically have to go back to some agreed point in the past and play all the validator results back up to the present. You know what I mean? So it's like, it's not just, that's why validators have to stay online. That's an effect. That's not the cause. Validators stay online because the entire protocol, its trust, comes from a high level of interactivity. Fundamental issue that in proof of stake systems, there's no way to tell. And we know this as we roll out our bonding system. One of the reasons why our bonding system has a very high number attached to the bond is to get out of this proportional voting kind of thing that you find in a lot of economically secured systems like Comp, Maker, proof of stake. What those systems try to do is that they try to meaningfully decentralize by basically making different roles for people. So you look at something like Polkadot, there's nominators and there's delegates and there's validators and operators and all that kind of thing. And it's important to think of those as different actors, because by having different actors, you end up with a system that's secure because everyone's supposed to be basically checking on each other's work.
Right. Yeah.
So whereas with proof of work, of course, the same thing applies, but the two things are different. One, you can't stop somebody from participating in a proof of work system. All they need is some hardware. And then two, once that population is in place, it's very hard to actually kind of go in and change ownership just because, say, you've got a lot of money. Well, you also have to somehow get access to those physical plants. In a proof of stake system, all you need is money.
DeFi is interesting longer term, but to be perfectly blunt, it makes me a little bit sad that is the most innovative thing that we can do with this technology. We're just taking crypto and turning it into structured products that remind me of, what crashed in 2008. These things are useful, but really it's just, money shifting hands, just like back in 2008. I'd much rather be doing real applications that are really touching the world and are changing things in a fundamental way than just, making new types of financial products. And I get it, given the limitations of Solidity and of the EVM, this is pretty much all you can do safely. The second that you try to have two smart contracts interact, you end up with a parity multisig problem where, if I'm interacting with some other contract, if I'm importing it and it's giving me some price feed, if that price feed contract that I'm pulling in data from blows up, then my smart contract might blow up in such a way that I can't actually unlock it or migrate it. I can't actually go and upgrade it. You end up in this weird situation where all you can really do are things that are tokens or look like tokens. And the most creative thing that you can do with that is this kind of new class of structured products. And there are interesting parts to DeFi. It challenges the notion that we need an exchange, for example. Having just a direct peer-to-peer quoting system on a base layer public blockchain, you can do weird structured product things with it. That's interesting. That's new. But overall, I like DeFi in that it's keeping the momentum of the space going, but it's not where the space is ultimately going. This is the let's say this is the intermission before we get to real business.
So I'm really not of the opinion that layer 2 is going to allow for innovation. I think it's actually going to significantly get in the way. I think hub and spoke is where DeFi goes after it's proven out that it can work on layer 1.
Would DeFi be better off on Kadena rather than on Ethereum? Based on what you said.
Absolutely. It's not really even that much of a question. It's the between the smart contract language that has formal verification built in. Like we designed, Stu and I come out of finance and regulatory on the financial side. So it's like we've seen. We have this just 30, 40, 50 years experience in that sector, and that allowed and informed how we designed the language that runs on top of the blockchain. Solidity and the EVM were very much a free for all, world computer, which is a cool idea, but here's what DeFi needs. DeFi needs something that is reliable and safe. Most of the things that DeFi needs should be built in as a native, like governance of a smart contract. That shouldn't be an extra contract or module you have to load. That should just be natively supported by the protocol, like Pact has. Formal verification. If your language can't be formally verified in a total way, then you shouldn't be using that language for billions of dollars of assets. Now, we can get away with not doing it for a bit, but if we're really going to scale this thing and we're really going to democratize it and bring a lot of people into it, these things, smart contracts need to be very simple, clear, and safe. Now, you need the ability to have interoperability in a safe way. Parity multisig showed us that having contracts interact can spell disaster for the operators and the users of those contracts, because if a dependency that's downstream, that's upstream from a contract fails, so, your contract is trying to work with the compound contract, and the compound contract locks up in just the wrong way,
your contract may also get locked up and be irrecoverable. We've seen this before. Ethereum has shown before, and I believe it's showing us again now, that its fundamental limitations limit its growth. Ethereum should have gone and taken over the world over the last 5 years. If they had Ethereum 2.0 or just some notion of scaling and scaled up mainnet and had some way of upgrading the EVM to be way safer, then it would have taken over, and I don't think there'd be many competitors with anything out there. But it has utterly failed. And that's really what we were trying to do with Kadena, is to have something that doesn't have those bounds on growth once the momentum starts to pick up. I mean, DeFi is hot right now, and the prices are probably going to spike through the roof over the next quarter and a half or two. But everyone knows that fundamentally, DeFi is never going to grow that big because the throughput of the network just isn't that high. And people can talk all they want about optimism and about ZK snarks and starks and rollups. Those are great and all, but for rapid innovation, those are really not the type of thing that you want to be using. And it also adds this hurdle of complexity to a already complex and very dangerous system. MakerDAO and Compound and DYDX moved heaven and earth to make safe contracts, and they managed it. But now imagine adding on, another significant layer of complexity. So I'm bullish on DeFi. I'm not too bullish on Ethereum long term. But who knows? Could be wrong. I'm not a believer that gas should be very expensive. Like, you don't want to have gas be free, because that means that people can just grief your system, and that's annoying.
How does Kadena avoid having the same issue that Ethereum has with, high gas fees, or when you have all that throughput and when you're trying to scale things up? Gas
prices now are a function of networks not being able to scale, of ETH 2.0 not launching, and Bitcoin not really wanting to scale up their base layer. That's okay. But the way that we avoid it is that we crack scaling. We can just make our layer one bigger as the community demands it. And then that also negates the ability for competitors to come in and to try to poach things that we can't service. Right now, most of the DeFi projects, the people that we've had trouble talking with over the last couple of years, are now much more interested in talking with us, because a lot of people are looking for a plan B, because they don't really buy Ethereum 2.0 as something that's ever going to actually exist in the way that it's been pitched, and that's actually going to scale. They think a proof of stake chain might exist, but the idea that they're going to have a sharded proof of stake network that's safe and launches anytime in the next 3 years, I don't really know anyone that buys it.
When we were at JP Morgan, my co-founder and I, Ethereum launched, and we started basically working on it and trying to see if we could get it integrated into the projects that the R&D group that we were part of was working on. My co-founder actually went and implemented the entire Ethereum virtual machine on the beach when he was on vacation, because one of the guys in our group basically challenged him to do it and said, yeah, you probably can't. So of course he goes and does it. And we found really quickly, especially after that research, that if you're going to have smart contracts be running in an enterprise context, they need to really be designed for it. It can't just be some kind of free-for-all CPU that allows you to do token issuance, but doesn't have some very basic ideas of what an enterprise needs baked into the core. So one thing that we knew we could never do is to go and take an Ethereum private blockchain platform to a business owner at JP Morgan and tell them, oh, but by the way, if a contract breaks, we're going to have to go and hard fork the whole network to go and fix one little bug in one of our contracts. We'd be laughed out of the room, or we'd be fired, or probably both at the same time. That was one of the many questions that we ended up finding when we were doing market research at JP Morgan, because we were trying to find a good private blockchain stack to take to enterprise business users. And we couldn't find a solution, so we left. And when I was working on the consensus protocol, he went and created Pact, and it was to answer all of these questions of how do you govern things, error messages, how do you get data out of the blockchain, which is a huge question. A lot of people don't realize that getting data into the blockchain, at least if you're talking about Ethereum or very low-level CPU, is much easier than getting it out. So that's why Pact integrates with normal databases. So you can actually put it on top of Postgres or Oracle or SQL Server, so that you can just attach it to your backend. If a business, even an entrepreneur, wants to go and use it, they need to be able to use the tools they already know. They can't just be stuck using some new cryptographic database and that's it. There was a bunch of other things that after you solve these initial set of problems, you get more questions. And they end up leading to having this Turing-complete language that totally generalizes over a lot of the notion of kind of cryptographic authorization. You end up with this interesting capabilities-based model for security, which as a user for Pact, you don't actually have to care about. It looks natural, but as a PL nerd, you're going to love it because it's not even a capability. It's actually the dual of a capability if you look at it from category theory. But it doesn't matter. The user is targeted at being a lawyer or an executive. So like a developer is not going to have to worry about that stuff. That's just, if you want to go and actually think about it more. So by evolving Pact in an enterprise context, we were able to kind of remove at the start the notion of coin speculation as the motivating factor for why you would care about smart contracts. And instead, we were able to focus on real world business applications. Tokenization is enough to grow $40 billion more value. The next thing that you could solve and probably grow another 40 billion is smart contract just interop or interaction. So being able to have two contracts interact. Having a generalized form of governance so that if you are, if you write a contract and it has a problem, there is a roadmap to being able to upgrade it. There's a path, there's a technique for it, so that you don't have to worry about just being locked out of that contract forever until you can go and, text the right person and get them to, start politicking to hard fork the network. But also it needs to be able to integrate with existing systems. So getting the data out is a very big thing of being able to actually use existing databases as a way of just being able to look at the data without needing to go directly into the blockchain. On top of that, having it be approachable by non-developers, that is a really core thing, because if we're going to expand this market significantly, we're going to need to have people who aren't just developers looking at this stuff and using it and understanding it. On the actual protocol side, on kind of like the coin, the base layer, especially public consensus protocol, you need something that has the ability to scale without consuming too many more resources, and has a real line of sight on if adoption takes place, what are we going to do to increase capacity?
Very quickly, people are able to grasp how our platform works. They're able to understand that it is actually a real blockchain, and that their developers actually end up loving the platform and the technology, and end up being able to very rapidly iterate on taking a concept to being an actual MVP or even into production. We have numerous examples now of a development team going from not even knowing how to use a blockchain or what programming on top of blockchain looks like, to go from that stage of knowledge to being fully fledged experts and migrating an entire application from EVM or just realizing an application in Pact in the span of 2 to 3 weeks. Generally speaking, a developer takes a few days to learn the language because it's A, designed for lawyers and executives, and B, it's designed for safety. So by designing for safety, it makes it much easier to do this rapid iteration new product development cycle. So that's one of the things that really inspires a lot of our partners and clients, is this potential for, wow, I can have a fully distributed, incredibly robust blockchain-based solution that is running a product in the span of a few weeks. Whereas if I were to use traditional technologies like normal RDBMS like Postgres or Oracle, and put let's say Go or Ruby between that and then the front end, that process would take anywhere from 3 to 6 months. But because this blockchain technology that Kadena is offering gives you so much of that robustness up front and for free because it's on top of a blockchain, we're able to take idea to reality far faster than we ever thought we could. Pact is really the killer app of our platform, in that it is a language that is designed to be specific to the domain of blockchain transactions. So it is a simple, easy to use language. It's designed for lawyers and executives to be able to read, if not write, because in 5 years, when blockchain technology is taking off and going through the roof, you're going to need to have lawyers and executives be able to review smart contracts, either for compliance or to make sure that the business flow is being adhered to. Also, Pact is designed for integrating into the gnarliest large enterprise back office database systems. We know that any system that takes off and gets adoption is going to run into the problem of how do you integrate it with the world as it exists today. Part of that is integrating it with the lawyers who you're never going to train to be engineers, and that is addressed by making an easy to understand language. And part of it is by having a language that's designed for interop, that is designed for having interactions with existing back offices.
The thing is that Pact is simultaneously safer and more powerful. And that's because it's an interpreted language. So to give you an example, we can offer functions that do, quite feature-rich things because it's similar more to something like a stored procedure language on a database, in the sense that you can do all sorts of complex things with your data. But the things that you can't do in Pact is you can't have unrestricted looping, you can't have recursive function calls, and you can't reassign variables. So between those three things, you eliminate this, like every significant Solidity bug has been some kind of recursive call that an attacker is able to exploit. Those are impossible by construction with Pact. So that's just an example. But it actually is very easy to use. If you've ever worked with a database, working with Pact is very natural. You basically define tables, you stick stuff in tables, and let's face it, that's what you're doing on a blockchain, is that you're updating state, you're making sure business rules are right, and you're trying to get out safely, report some events, and move on to the next thing. And that's what Pact is designed to do, along with a few other. The other big thing with Pact is that it's multi-sig native. So none of the complexities you encounter trying to incorporate something like Gnosis into a vanilla Solidity transaction, that's just built into Pact. We started looking at that and we realized that that was a natural fit for Pact, because when you have that kind of two-chain construction where both chains are aware of each other's headers, they become perfect oracles of each other's hashes. So at that point, you can transfer coins back and forth in a completely trustless, non-interactive fashion. And it allowed us to conceive of the idea that there could be one coin on multiple chains. But you can only do it with a non-interactive protocol like proof of work, or some other Nakamoto consensus that doesn't exist yet, such as what Bram Cohen is working on. If it's a Nakamoto consensus, you can do it. So if Bram Cohen's version of proof of space and time, once that comes to production, that's something that Chainweb could consider, because it has the same features of non-interactivity, because proof of stake is a very interactive protocol.
The easiest people we have to convince that, hey, you should take Pact seriously are 100% Ethereum developers. People who've worked in Solidity and have gone through that pain where you have to move heaven and earth to even have very simple things be safe enough to be able to deploy. We show them Pact and they just go, oh my God, I don't need to spend 6 months just getting very basic upgrade and governance systems in place. These just all come natively. And we're really excited to be working with industry leaders with Pact like Cosmos and Polkadot, because they see the potential too. Especially Cosmos. Tendermint is this wonderful consensus layer, but it doesn't come with any native smart contracts. And while there is Ethereum and EVM, the EVM on top of one of the Tendermint builds, it's still just as problematic as when you use the EVM on top of Ethereum. So it's why we started working in conjunction with the Interchain Foundation on building Kadena Mint, which is already in the Cosmos ecosystem. And this will allow people in 2020, 2021 to go and actually build applications in Pact that not only can interact with the Kadena mainnet, but are actually part of the Cosmos ecosystem as well. Pact is what we all wish smart contracts could have been, and the type of technology that, had it been in place 5 years ago, we wouldn't be where we are today, where there was a lot of interest, there was a lot of uptake by enterprises, a lot of uptake by investors. People saw the potential, and then the technology just got in the way and failed them.
What we've really seen with Pact is that a development team can learn Pact in a matter of days. One of our first clients was a Fortune 100 healthcare company that started the Synaptic Alliance, which is a major blockchain alliance in healthcare. And they were able to complete their Pact prototype in 6 weeks. And it was kind of funny. There was a major consultancy working on the product that came through with their big report on what a blockchain solution should look like. And they were saying, well, this is going to be so hard to implement in Ethereum that we think everything shouldn't happen on the blockchain and we should just be timestamping. And it was funny because the devs, not our devs, but the healthcare company's devs, they were like, yeah, we're already done with our prototype. And so we've had this experience over and over again. We have a client, we're going to be making an announcement soon about a fintech client that is switching off of Ethereum. They spent a good year building their product on Ethereum, with a lot of trepidation because Ethereum is so unsafe and it's really a very difficult tooling environment. It's just very hard to use. Not only did they get their main use case done and deployed on Pact in under 2 weeks, they then gave us this fantastic demo with this beautiful front end. Even though Pact is written for non-developers, that actually makes life better for developers because we liken it to writing Excel formulas. Excel formulas are very powerful, but nobody ever crashed a computer system writing an Excel formula. I mean, someone might have crashed the economic system using Excel, like some crazy trader, but nobody ever crashed their computer writing an Excel formula. And we feel that smart contracts should be the same way. You might be able to do all sorts of crazy things with a smart contract in the business sense, but you shouldn't be able to have these kinds of horrible bugs and exploits because real money is on the line. That's what we learned when we were at JP Morgan. The smart contract language that you write applications in has to be safe enough for companies that have, trillions of dollars on the line, but easy enough for a small entrepreneur to be able to get their use case out the door in, less than a week. It's not just human error, because the problem with relying on developers the thing that people need to understand is that you can't expect developers to be perfect. And by perfect, we mean more than just human error. We mean think of every single possible thing that can go wrong. That's just not a human capability, but that is something that we have in our sights for being able to do with smart contracts. Smart contracts that are not using these tools are really putting their users at risk.
A lot of the people who are going to try using this stuff at first, they're not the richest people. They're people who they're putting a lot of their net worth into a project that's on top of these platforms. And the idea that they could end up in a situation like Parity Multisig, where they had, let's say a third of their net worth locked up on a multisig contract, and then it gets locked, and now you can't go and get that capital out. That to me is worse. So my first kind of instinct in all of this is to be an engineer and to have something that fails safe and that is something that won't really screw you over when you try to use it. It's about smart contracts. That's just it. And there hasn't been enough focus on smart contracts for business. You need these things to be able to be legible by lawyers and executives. You need them to be safe enough to actually trust. They need to be legible on chain so that you don't have some compiler bug that all of a sudden turns your multi-million-dollar business upside down. And finally, the last bit is that you need something that has high throughput on a public blockchain. And I'm not talking here about proof of stake or DAGs like Hashgraph or any of these other scaling solutions, air quotes scaling solutions that are really just diminishing the decentralization of a public blockchain, this piece of infrastructure that we can all use that no one owns. You need to have a scaling solution for proof of work, and Kadena is very special. It has a very different place in this market because we actually have the only scaling solution for proof of work, one of the few proof of work projects left, and this is our Chainweb protocol. It allows you to braid multiple different chains together into one network so that for the same amount of hash rate that you would need for one chain, you can instead have 10 or 100 or 1,000 chains all running in parallel with none of the liquidity problems associated with something closer to a hub and spoke approach or staked channels or any of the other myriad of approaches that you're seeing the crypto sector experimenting with today. And once you have all of those and a company that's been focused on business for years and has the lead time needed to actually be able to go and deploy enterprise applications to a public blockchain in a hybrid context so that there's public and private parts of it that are running together to actually go and demonstrate here's how you make money and here's how you do it. Once you have all of those things, which Kadena has and we are unique for having, then you can start to talk about, okay, how long is it going to take for people to kind of get wind of, whoa, this stuff actually now works? Because to your previous point, Hyperledger Fabric and Ethereum are not capable of doing real business enterprise work. Little POCs here and there, sure, some small internal stuff, but the second that it needs to go prime time, the second that it needs to go to the masses and have the scale and the safety that's needed when you're putting real money at risk on these things, those solutions just don't work.
And on funding, you guys recently raised funding, or was that a while ago? I know you guys have some serious backers from CoinFund to Multicoin to Scalar, et cetera.
Yeah, we raised 2 SAFT rounds for a total of 15. That's $15 million last year. Metastable, Multicoin, CoinFund, Scalar, VI from the crypto side, SIG or Susquehanna, and Fidelity from the institutional side, SV Angel and Passport from the VC side, and then a number of other players as well. And that's the last time that we did fundraising. We have the capital to get to launch, and that's what we're completely focused on right now. As for the second bit, how to widely, fairly distribute wealth after having private sales, our approach is just to keep the private sales pretty small and not have like a multi-billion-dollar valuation for the network type of deal where there's just going to be this huge amount of tokens that are locked up. I think the other part is that it's an aspect of at least how Chainweb works, in that as utilization increases and we hard fork to larger and larger networks, it becomes feasible for people to do kind of Merkle mining of individual chains. So I expect to see pools on Chainweb. So because you're doing that, you end up having these pockets of people who are running who are replicating a couple nodes or a couple chains, and they're mining on a couple chains, and it allows for higher decentralization, so that you can effectively just start decentralizing the mining a bit more. Function. We have some research that we've been doing in that we think we have a way to be able to have multiple hash functions being mined in parallel on the same network, and it's because we're this sharded proof of work blockchain, so we have multiple proof of work chains braided into one network. We can have theoretically 5 or 10 of the braid of the chains that are in the braid running one algorithm and the rest of them running another algorithm. This is still earlier stages of research, and we think it's possible, but we realize that it's like a pretty novel form of research because no one's ever figured out how to actually have completely distinct mining communities. And the ideal long-term for us would be that we would have like one algorithm like Frog POW or E4R that's for GPUs, one algorithm that's for FPGAs, maybe probably one that's for CPUs, and then 1 or 2 that are for ASICs. This is when we scale up to 100, maybe 500 chains, and have 3 to 5 different algorithms, actual mining camps that traditionally hate each other, actually mining and coexisting in a collaborative way on the network, because they would have different segments of the network devoted to their respective mining focus at a given period of time. It's this really cool idea that actually it's almost like enforced decentralization. So it's this idea that you can actually have multiple distinct mining ecosystems collaboratively making your platform more decentralized and more robust.
Stuart, what else do you want to share? Anything else about what's happening with the project?
Well, I'm really excited about NFT. We are working with a company, at least one. We're actually talking to more than one, but we're launching at least one NFT, and some of them are actually going to be trying to look at different models within the NFT ecosystem, looking at things like fractional ownership and other ways to. Right now, NFT, in the large, is basically functioning as no better than the current art market that's out there. And it's nice to see that market maturing in crypto, but it's not innovating. It's basically doing something. It's taking basically collector-based dynamics and just putting them on a blockchain, and glad that's working. It's exciting to see it actually starting to happen. But a lot of the froth right now, it's no wonder that Sotheby's Sotheby's? I can't remember which auction house auctioned off an NFT, because that's what they do all day.
Like $7 million or something like that. It was like some ridiculous amount of money.
But that's what they do all day long. And, the art market is not exactly a paragon of like fairness or, equitable distribution of income or anything like that.
That's very true.
So, so while it is definitely exciting to see this other, to really see that model blockchain, and DeFi are perfectly set up to sustain. There's a lot of other things that you can do with smart contracts. Now, and some of the things people, one of the big things people tout about NFTs today is, hey, well, at least every time it changes hands, at least on some of these systems, the original artist will get a cut. There's a lot more you can do in that realm,
Yes.
Because, you can think of things beyond like a single person being the person who issues it. You could think of a community being, the issuer and things like that. So you're going to be seeing some exciting stuff coming out of the Kadena ecosystem surrounding NFTs. But then the other thing, of course, is this thing we're talking about gas, right? If it's annoying today that to trade on Uniswap, before you do anything, you have to have an account with Ether in it. Before you even know what crypto is, you have to hold ETH in order to be able to use something like Uniswap.
Yep.
So, where we're going to end up but with NFT, it's even more absurd because, ETH is a pretty nice cryptocurrency. So it's not the worst thing to hold when you're going to go start working with a system like Uniswap.
Yes.
ETH, when you're talking about an NFT, may really not be what you want. It might be something like a stable coin, it might be something else.
Yes.
But having to deal with the platform token, having to deal with a crypto system at all to start working with these whatever they are, collectibles or art pieces or things like that. So that's where we're really excited to be working with Cellcore Wallet and with CoinMetro and other kind of forward-looking exchange partners to get a fiat on-ramp and get a so between the fact that we don't have to do that, we can have free gas, so you're not you can start doing transactions before money's changing hands, and get a seamless experience both for the wallet and for being able to come into the system with fiat. You get something that's much more like the web mobile universe, where it's like you come into the system and you deal with money when it's time to deal with money. That's like after you've filled your shopping cart and exactly what you want to do, and you've got the money to do it. And now, why is it so hard for me to use this system? We're going to make it that it's a seamless login, and it happens when it's supposed to happen, which is when you've converted that user.
We're
bring in the user with a good experience, and then once they're in is when you get the money. There's a model that can't really happen right now with NFTs, which is a small time artist being able to mint NFTs. Right now, that's going to cost them anywhere from $20 to $80 a mint. And if you're selling something like an album, or you're selling something like
it's not feasible.
It's just not. Yeah, you're going to lose money. So that's not going to work. So the sheer cost, which comes from congestion, and that's where you have to have a scalable proof of work system like Kadena to address that. Ethereum is proof of work but not scalable. Kadena is proof of work but scalable, so that we can always grow the network to accommodate congestion, which is what drives gas fees in Ethereum.
Yeah, it's pretty cool that you guys could launch a full-fledged blockchain on $15 million. Meanwhile, there's projects that raised hundreds of millions of dollars that are basically missing at this point.
Yeah, I'm going to go with a no comment on the why.
No worries. That's why you have me.
If Bitcoin wasn't so inefficient, proof of stake wouldn't have existed for at least another 1,000 years when people got really bored of blockchain and decided they needed to start coming up with stupid, pointless bullshit to justify funding, etc. Absolutely 100%, proof of stake is pointless bullshit.
I work in an academic lab that does research in quantum sensing. POS is pointless bullshit. Anon, would you do us the honor of explaining why you think POS is bullshit?
It's far less secure than POW. POS is an attempt to improve on Bitcoin's inefficiency, nothing more. If a scalable POW blockchain arrives on the scene, Kadena, POS becomes obsolete. POS will still see adoption by corporate fellas, because it allows rich people and early adopters to outvote everyone else. But POW is pure Nakamoto consensus. Proof of stake also causes huge problems when you can lend your coins out. By manipulating interest rates on the chain, you can force stakers to move their holdings to liquidity pools, and this makes it easier for malicious nodes to outvote the rest. In fact, this can happen entirely by accident. Why stake if you get better returns lending? Bitcoin basically had things spot on. It's just inefficient and slow. After 10 years of wild experimentation, we are finally seeing new, well-reasoned approaches to blockchain tech, and Kadena in my mind is so far ahead it hurts my brain.
What advantages does this Pact have over, say, Solidity, which I could also use?
So easy to read and write that a technical lawyer can reliably program his smart contracts with a little practice, just like he could learn to manipulate data in Excel. Formal verification, which is invaluable when you're dealing with critical systems, i.e. those that handle a lot of money or play a key part in infrastructure. Turing incomplete. Prohibits recursive function calls, unbounded looping and variable reassignment, which eliminates the potential for exploits that have ravaged EVM languages by design. Upgradable contracts, whereas Solidity contracts are final and require proxy contracts, etc. It's a next-gen smart contract language that improves upon Solidity, much like Chainweb is a next-gen blockchain that improves upon its POW predecessors.
It all starts with Will Martino and myself. We built the JP Morgan blockchain group in late 2014, which was really important to get to know all of the players at the time. We had everybody coming in because everybody wanted to talk to JPM, Vitalik, R3, IBM. Interestingly, after founding, one of the first people we worked with was Stuart Haber, who helped us formalize our security proofs for Chainweb. Yes, Stuart Haber is the most cited author in the Satoshi white paper. But yeah, Stuart Haber is heavy. We're working with him on our decentralized bridge design. Currently it will be a true generalized bridge too, so it will be able to do NFTs and any crypto asset, not just tokens. The future of Cadex is a single market on Kadena, Cosmos and Polkadot. It will be like stocks in the US, where you can trade on NYSE or Nasdaq or like 9 other exchanges, but functioning as a single market. Well, Cadex alone is resonating in a huge way. For instance, Tokensoft talks about settling all of their wrapped coins on Cadex someday. The idea of a scalable POW settlement platform is too powerful. Today, we can settle the entire US stock market without breaking a sweat on 20 chains. Cadex and other markets will be able to grow without limit, but also without gas prices creeping up. NFT is too expensive for the independent artist or musician, but also, it's too hard to customize the NFT experience to create innovative cash flows, royalty models. But most importantly, no gas. Content creators shouldn't have to pay an inexplicable huge tax to mint NFTs. Why did you choose Polkadot? Are there any plans to add your project to various blockchains in the future? We didn't choose Polkadot, they chose us. There aren't a lot of truly portable smart contract languages. For instance, Solidity, you bring all the warts of Ethereum with it, and that's why we integrated Pact into the Cosmos platform as Kadena. So really, Pact will be on every smart contract platform that matters. This is separate from our direct partnerships and integrations on the financial side where we bring assets over, and Polkadot is further down the line there. ETH, CeLO, Terra come first. Token-wise, why do we need KDA and what can we do with it? KDA will be the coin of the realm for a settlement platform that can settle every crypto on every platform. As such, it will be involved in countless liquidity and lending regimes. Basically, as the home of DeFi, KDA will have endless, reliable liquidity, making for innovative and profitable financial engineering on top of it. It's odd that the centralization problem of proof of stake has been largely ignored during this bullrun, despite the fact that VCs within POS ecosystems have gained immense amounts of power in their ecosystems.
It's pretty ironic the only ones who got this right are some guys at JP Morgan. It's like everyone else is greedy except big banking, and the world was upside down all along.